Hi, folks. Jeff Clark here. We're a couple minutes before the hour. We'll go ahead and get started. I just want to, first of all, thank you for taking the time to go through this today. This is a webinar that I've done, I don't know, I guess 7, 8, 9 times. And over the course of the last year and a half, I've changed it, I've tweaked it, and then of course some of the rates have changed on me. A lot of the carriers now, the long-term care rates went up. As long-term care interest rates continue to kind of, stay low or at all-time lows, companies like the long-term care companies that are so dependent on having that money for 28, 30 years, when you have that long-term interest rates that decline, these hybrid products, these long-term care products have just really been, that they rely on that. So you've seen a lot of price increases on premiums going forward, not rate increases on existing, but the price of getting long-term care just seems to go up and up. The long-term care has kind of leveled out now. They've got that figured out, but I'm seeing now the hybrids are going higher. Mutual of Omaha rates have stayed the same now for the last couple of years, I guess, 18 months, but NGL and National Guardian Life's long-term care and a lot of the hybrids are taking these increases. So we just updated some of these stats, and so I'm going to send out a copy of this PowerPoint, but we're going to update some more, and it's kind of a constantly evolving thing when you do these PowerPoints. As many examples as I have in here, but what I want you to kind of concentrate on is the concept behind it. So in other words, we're just trying to compare the long-term cares to the hybrids in theory. I have a fresh example I just put in here for a quote that I did yesterday. So in other words, I'm hoping that the point comes across that there are certainly better ways to fund the long-term care need other than a hybrid. So when I first started doing this, it troubled me how many hybrids were being sold. And I think I've said this stat before, but 10 years ago there was 5 traditional long-term care plans sold for every one hybrid. And when I say hybrid, it's the life and long-term care combo. So now we fast forward to now, and now it's like 4 or 5 to 1 the other way. There's 4 or 5 hybrids being sold for every one traditional long-term care. So what's happened? And a couple of things. The biggest thing, in my opinion, is as we saw the rate increase struggles that long-term care, traditional long-term care premiums experienced, it really kind of put a bad taste in a lot of consumers' mouths. Financial planners and other people that that did a lot more of the hybrids kind of had their use it or lose it, and these premiums can go up, and so there's guaranteed premiums, and you don't just put premiums into something. If you die in your sleep, you don't lose it. And so the problem is that with that thought, we've overcorrected, if you will, in my opinion here. And these are all my opinions. You can take them for what they're worth. But there's been a big overcorrection in the area of hybrids. And so I don't want to talk about this being LTC versus in some, battle royal, because I do want to say this. The demand for, and let me go into presentation mode here. I'm going to switch out because I have some. Okay. So let me just say that, there is no one great silver bullet for every long-term care planning strategy, right? The demand for long-term care has never been higher. We're seeing the budgets in America, Medicaid, Medicare, they're all in trouble. The limited liability of these programs has just gotten to the point where, we don't even know if they're going to be around 10, 20 years from now. So the importance of planning for a long-term care event, with 80%, 90% of married couples requiring it, it's very important. And there's no one good way that's always right. I favor traditional long-term care, coupling it with a separate standalone long-term care or a life policy if you're worried about getting your money back. But there's multiple ways to fund this need. So we're looking at these. So without being combative, or there's no right answer every time. But here there are some good reasons to sell a hybrid and life long-term care product. They're here for a reason. There are people that are rolling over existing or repositioning old life for annuity contracts. Hey, perfect. It's a tax-free exchange. You got that money sitting there doing nothing for you. So you got 160,000 laying around in some account. Yeah, that makes sense. Sometimes there's a couple, not many anymore, but there's some uninsurable health risks that maybe the hybrid, and this is more of the annuity-based hybrids, Not a big fan of those anyway, but if there's as a health concern, you might find a hybrid that might take, I don't know, lupus or something where a traditional long-term care won't. So there is some that there is a desire to receive 100% cash benefit. You know, that's a hard benefit for any carrier to pay out. You know, I know back in the day, MedAmerica tried to do it, didn't last long for them. But you know, that's like your Securian, your Nationwide are all cash payouts. That might be a reason. Sometimes you have a client, and I've run into this, I'm sure we all have, they just refuse to buy a traditional long-term care plan. Doesn't matter what you say to them. Either their brother-in-law, who's kind of the know-it-all guy, the financial guy, or the financial planner, or someone at church has said it's the dumbest thing ever to buy traditional long-term care. Maybe it's the whole golf foursome, and you know, they've all said, yeah, that's, you don't want to do. So there are clients that literally, even if it's the right answer and it saves them $5,000 a year, they won't do it. So yeah, there are situations, and the guaranteed or paid up premiums, you do actually have this availability with traditional long-term care now. You have some paid up options that are guaranteed. So we can get around that guarantee or the rate increase thing. So these are all good reasons to sell hybrid, but I want to be very clear at this point. The fear of use it or lose it is a terrible, terrible reason to sell a hybrid. You know, it's with a hybrid, you're using it and you're losing it. So I try to, you know, I'm stealing this actually from a guy named Bill Comfort who does a lot on this. He has some great stuff in the same topic, but just in case Bill's on or whatever, I love that line. You know, the reason, unfortunately, a lot of agents are flocking to the hybrids is because of fear of this use or lose it. In reality, it's just not a good deal for the client. It's use it and lose it. I'm gonna try to show you why. Okay, so 3 big abilities to consider with traditional. You got rate stability at this point, finally. You can get guaranteed premiums. Plan design flexibility, which is huge. I mean, remember, we're trying to solve the long-term care planning, you know, in case you need, that's what we're trying to do to begin with. So if you want to do the best job of actually planning and to care for your loved one, your spouse, to have good options for your care, then there's nothing better than a traditional long-term care plan, right? These hybrids usually are reimbursement contracts sometimes. You know, it's limited to what they can do in home health care. You're not going to pay your spouse, your friends, your family, your neighbor kid for mowing the lawn. So they're not the best solution on that. And of course, the tax deductibility. With traditional long-term care, you have, you know, 100% tax deductibility of the premiums, where the hybrids, you can only deduct the long-term care portion of, say, a hybrid, not the life. So, okay. First of all, the biggest thing that people come after traditional long-term care is rate stability. You know, they've had rate increases. I touched on it earlier. Modern policies have way more stability than any of the previous generations. Why? Well, there's been all kinds of claims paid out now. Somewhere, you know, near $10 million a day are being paid out in long-term care claims. So lapse rates are now set at less than 1%. Originally, they were set at like, you know, 6%. So when this product first came out 20, 30 years ago, the actuaries frankly just missed the mark. They didn't price it right. And so you did see some rate increases that were huge, you know, 30, 40, 50%, sometimes 2-tiered ones, 30% one year, 40% the next year, 100%, 120%. They all got it wrong. No one carrier came out and said it was more or less a learning thing, growing pains, that people basically don't lapse these things. And the long-term interest rates kind of took a dive in this country, which didn't help either. So if you look at the thing now, the Society of Actuaries have actually de-risked the increase of premiums on these long-term care policies. So if you look at this here, and this is just showing you chance of rate increases according to the Society of Actuaries. This was also from a great article about rate increases and long-term care. It's an article called "Too Legit to Quit" from Broker World Magazine, March 2017. What a great article, and I've referenced it for years. So in year 2000, long-term care plans had a 40% chance of going up, and the average rate increase of those was about 34%. That was 20 years ago, and that did happen. I had a lot of clients. I've written 780 long-term care policies, most of them in the early 2000s. So yeah, I've went through all this. But if we fast forward to 2014, 10% chance on the average of going up, and the average projected increase is about 10%. I saw 2018 stat out there. It was now dropped to 5%. and the rate increase again was 5%. So they've gotten these dialed down to the point now, and that's because they have all kinds of claims data. They know what they're doing. The product's been around for 30 years now. They've using ultra conservative interest rate models. So we're just not going to see the rate increases that so many people talk about, that they had the bad, the good, bad, and the ugly from the 2000, 2007, and some of those older policies. So the policies are a ton more stable today. All right. Flexibility. And I talked about this earlier too. You can't beat the long-term care. You can't solve the long-term care problem any better way than traditional long-term care. And just for example, I can play around with a long-term care, traditional long-term care. And this is Mutual Omaha I'm using. But just to give you an example, I've done this for years. I show this to a lot of agents, brokers when I'm quoting things. If you're looking for a pot of money of $270,000 as your long-term care benefit, I can get that at $4,500 a month, or I can get that at $7,500 a month. So this is a shorter, fatter. Sure, it's only a 3-year benefit versus a 5-year benefit, but 80% of claims don't go beyond 2 years. So you want to really shorten and fat and stack that benefit for the short term, because and really when you're paying premiums, don't you just really want to extract the $270,000 as quick as you can? You want to get your money back. So design these things in this left model here, $4,500 a month for a 5-year period, a long skinny, and then you use 5% compound, right? The premium of this is $11,000. If I shorten and fatten it up to a 3-year plan, $7,500, 3% compound, $8,600, drops the premium. And by the way, look at the benefits. Now, $10,000 versus $7,000. In 20 years, $13,000 versus $11,000. In 30 years is about the crossover point. People are buying long-term care. This is, by the way, these premiums were for married couple at age 60. That's what I did with this. So average claim happens at 82. So pretty much this design is going to keep you ahead for the next 30 years. And honestly, a $10,000 benefit 10 years from now is going to be a lot stronger than $7,000. So shorten and fatten your policies up with the new rates that Mutual has. I even went shorter and fatter. I'm dropping my policies down to a 2-year, still using $270,000, but I go $10,000 with 1% inflation now. I don't care about partnership. It's another discussion. Partnership just doesn't happen. It's a great door opener, but so if you're, it's a word to the wise. All 3 of these benefits here have the exact same pot of money, $270,000, right? The premium here is half by going $10,000 a month, 1%. And look at these crossover periods. In 20 years, they're all paying about the same amount. Okay, so don't worry about a long payout. Most of the claims happen in short term. So, anyways, that's the flexibility you have with traditional long-term care versus a hybrid. You can't do this with a hybrid. You get what you get when you buy a hybrid. You get a reimbursement set at X amount. So, what do I got next here? Tax deductibility. I think we all understand how that works. And I'll show you this later. In a hybrid, you can only deduct the long-term care portion. So like a quote that I have, just I think pretty quick here, it's a One America one. I think it's $7,000 for the life portion and $6,000 for the long-term care portion. You can only deduct that. And so with traditional long-term care, you're deducting 100% of all your premiums. Okay. All right. Let me go to this example here. Got a little example from Jack and Diane, a nice couple that I just quoted yesterday from right here in the heartland. I'll stop at that point. I think you guys know where I'm going with that. So let me show you some quotes here. Okay. So my point of today, and I'm going to show you a lot of examples of this, is if I were to take, would be a plus there. If I were to take a $1,300 premium, let me show you what I'm talking about. This is a life policy. This is a Mutual Omaha traditional long-term care policy. I add them together, I end up with $9,000. With One America, I have 13. Let me show you what I'm talking about. So instead of selling what do we do here? This is a One America asset care, right? Yeah, so let's look at this. So when I was talking about tax deductibility, long-term care premium is $7,000. The life premium is $6,580 for a total of $13,803. Remember now, hey, that the great story with the hybrid is, if I die in my sleep and I never need this, I'm going to get $166,000 back. All right, so I won't lose my money. I use it or lose it. No matter what, I'm going to get paid. Okay, so what you're paying then is $6,580 for $166,000 of life insurance. When you add the long-term care premium, because that's basically life is funding this long-term care, it's $13,803. All right. To get that, 166. But the thing is, you're not guaranteed to get that 166. If you have a claim, you're not getting the whole, 166. It's either or. You don't get both, right? So 6,580. Look how much that life portion is there. Take a look at what it costs for the same. By the way, this is a couple who are, Jack and Diane are 71 and 73. John there, but it is Jack. Yeah, Jack and Diane. So this is a traditional Mutual of Omaha plan that has $150,000 benefit, $5,000 a month. That's what I'm trying to compare it to. Okay. So this benefit here on this Asset Care by One America, $5,000 annual monthly benefit for a total of $120,000. So this is $5,000 and $120,000. So to get the same benefit over here with Mutual, I went ahead and ran a $5,000 a month benefit. Okay. And this again for 71, 63-year-old. So if you look at the long-term care portion in here, pretty close, right? I mean, 7,223 versus 7,728. So the long-term care portion matches up pretty good. But look at that life part. How much does it cost for someone to get $166,000 of total death benefit for a 71 male and 63 female? Well, the answer to that is $1,325.80. This is a second to die IUL, right? So flexible premium survivorship universal life, which is the same thing that One America does. Both don't get a payout of it's a second to die chassis. So same thing here. But look at what they charge for their life premium: $6,580 versus $1,300. So why is the life in this thing $5,000 more? I mean, that's 5 times expensive. And that's how they're funding long-term care. So my argument today, and I tried this a different way because I'm going to show you some examples that hopefully are. So if I add up then, going back to my problem again, 1,300 and the Mutual Omaha is, if I'm going to add this right here to this, right, I'm going to get 9,000. Remember the One America premium here, 13,803, and that's not guaranteed at both benefits. So let's just skip out of this so you can see what I'm doing here. So the Jack and Diane, where'd you guys go? Okay, so 1,326 for the second to die life at 166,000. Mutual Omaha, the premium was 7,728 for long-term care, total of 9,000 versus 13,000. And remember, with the Mutual Omaha, you're getting both benefits no matter what. You separate the policies; they're separate. So when you die, I don't care if you die in 3 years from now, you're getting your life insurance. Okay, and if you have a long-term care claim and you're in there for 3 years and you use up, I don't know, $100,000 of long-term care, and then you die, you still get your Columbus life benefit. So with hybrids, it's use it and lose it. All right. Let me give you some more examples now. And I'm going to kind of go through these. Try not to go quickly, but to try to follow you here. This is a little more advanced here. And I want to go through and show you every one of the premiums like I did. I just did that in the first example because I just quoted this one yesterday. Literally, I explained to this guy very carefully, he wanted to buy a hybrid. And so I, as a devil's advocate, let me send you a life and long-term care together, show him that it was 9,000 compared to 13,000, and you're getting both benefits guaranteed instead of having to pick between the two. I mean, you're getting, for half the premium, not quite half, for considerably less premium, you get both benefits versus getting one. So let me show you how this works out. I've got a couple comparisons here. I did Pacific Life. I want to pick on One America. One America is the leader in these things, so we do work with One America, and we write that plan. It's a great plan. It seems to be a leader in the clubhouse. It's the less expensive one because it's built on a second to die chassis. It's a reimbursement contract, so they've made it very affordable. But there are other ones out there. So let's look at Pac Life. Pac Life does theirs in a 10-pay. So the example I'm going to show you here, this is for a 65-year-old male and a 60-year-old female. The benefit that we did with that is a $330,000 long-term care benefit that pays out at $5,000 per month. And we have a 3% compound in there. The way they do theirs is you get $120,000 death benefit if you die in your sleep and don't use it. They don't give you the full 330,000 that's available for long-term care, but so they do give you 120K. All right, and actually each person gets that 120K there. So it's not like the One America where it's a second to die, only one. These are double payouts of 120K. So the premium for this 10 pay now, 44,088. Again, and I would argue that 5K a month for long-term care is just not going to get it done. But look at the money you're putting into this. 44,000 a year for 10 years. $440,000. I know, but you don't lose it. You get it all back, right? Well, you do get at least 240,000 back for sure, half your money. So what if I were to split this up? I'm going to do what Jeff's saying here. I'm going to break this into a long-term care premium. So what I did here is I did a long-term care premium with Mutual of Omaha. I did $310,000 benefit and a 5K LTC benefit. The premium on this was $12,760 for this 65 and 60-year-old couple, standard health. Then, because I needed to do a life premium, I did a second to die for this couple, the 65 and 60, for them to get 120K brat. Because remember, if I'm paying in $12,000 a year and this is a 10 pay. This NGL, by the way, is a 10 pay, just like Pacific Life's long-term care. So with this one, I'm going to pay 120,000 in premium, right? 12,000 times 10, actually 127,000. But so what I did then is, if people are worried about use or lose it, I'm going to give them a guaranteed $120,000 death benefit back, second to die. That premium was $31.27. When I add those two up, $15,887, as opposed to $44,000. But to be fair, this one pays out a double death benefit of $120,000 each. So I went ahead and did a 65 male at 120, just a simple universal life, index universal life, and I did one for a 60-year-old female. Again, being fair. So if you add these two up, so they both get 120, so you're getting twice your money back on this 10 pay. So I don't know why you do that, but you need the extra life? That's the other thing with hybrids. A lot of times people don't even need the extra life insurance, but okay. But we're doing this, remember, just because of use it or lose it fear. All right. So total here, even if I do it that way, I give them double benefits, which I don't know why you do, but whatever, to be fair, 22,000, still half price. So what does this look like? So if I use a Pac Life, and we're going to extrapolate because we have 3% insurance, 20 years later, this monthly benefit has grown to $9,000 a month. And the long-term care benefit's grown to $596.19. So if you use that long-term care benefit, you don't get the $120,000 death benefit. It's an either or deal here. Okay. So with my long-term care strategy of having a second to die life, my premium is my premium is only $15,000, not $44,000. I have the same long-term care benefit, $9,211 per month, a benefit of $559,000. And I don't care if I use it or not, I'm still getting my $120,000 back, all for 1/3 the price. Double the benefit, 1/3 the price. And if I do the NGL, again, this is with the two index ULs, because for some reason they want to have, 240,000 back. Well, then it's still 22,000 versus 44. And here I'm getting, again, twice both benefits guaranteed for half the price. This one really stands out to me. I guess, when I do these, the 10 pays are really, I don't know how many people have $440,000, for example, laying around to roll from one thing to the next. It's just not financially probably wise to do that. Okay, let's give you another example. This is Securian, same thing here. I'm gonna go a little faster now. What time do we got here? It's about 25 after. I'm gonna wrap this up in about 10 more minutes or so, just to show you some more examples. I think I made my point. Securian, same thing here. So their 10 pay for 65 and 60 was $21,690. And we did a benefit here of $121,000 long-term care benefit, which works out to 5K, and their $120,000 death benefit. Again, 3% compound. So the premium for just doing one second to die, which I believe in, 11,000 as opposed to 21,000. And you're getting, so I'm adding the 8,000 and the 3,000. So I'm buying a standalone long-term care and a standalone life. My total is 11,000 versus 21,000. And then I went ahead and did both. They each get, the 120K. That's why that's 17. So still, that way you're guaranteeing everything. You're giving $240,000 back, and you're giving them long-term care, and you're still well under the 21,690, 4,000 less. I would normally go the route right here. Seems like the math's off on this. I apologize. Just looking at this from the 3,000 here. If I only added 5,000 more, did I make it right? Yeah, it is. Okay. Yeah, that might be right. So again, when you look at how it pays out, you get the same monthly benefit for long-term care in all three examples here. Long-term care benefit total in 20 years, same benefit, 219, 224. I extrapolated all over 20 years. The death benefit. Okay, if I'm getting 200 with also securing, you're both getting a 120, so it's a $240,000 payout. Remember, this is an either or deal. Twice the premium, either one or the other. Here you get a guaranteed long-term care benefit and a guaranteed death benefit of 120,000, a long-term care benefit of 224,000. This is also a 10 pay, so 10 years at 9,000, at 11,000 is $110,000 you're paying in. You're getting all your money back, guaranteed. Even if you have a long-term care claim, getting all your money back. So I've taken care of the use it or lose it. I'm just charging them half the money for that. Again, this person would have to be crazy to buy a hybrid. I can't see it. Okay, same thing here. So what else we got here? Nationwide. Now this is a standard pay for a lifetime payout, not a 10 pay. So here again, 9,000 for 185K long-term care benefit, 5K per month long-term care benefit, 3% compound, $120,000 death benefit. So here again, the premium for that, for this married couple, it's 55 and 50. The premium's $9,356. So when I did a mutual long-term care premium standalone, to get a benefit of 185,000 at 5K at 3% for this married couple, the cost on that was $47.13. Okay. Life premium, $12.32. Get that second to die thing, right? Get your money back. That way I'm getting 120K back. And if I want to get two benefits back, it moved it up to $72.11. You'll see again, I'm coming well underneath that hybrid. And again, I'm getting both benefits. So for 5,900 versus 9,300, I'm getting pretty close to the same long-term care benefit, the same monthly payout. And if I happen to use long-term care, I still get my death benefit, guaranteed. Doesn't matter if I went on claim for 5 years. I'm getting both. So again, for not quite half, 40% off, 40% less, I get both benefits. Same payout in long-term care, same payout on the life, but I get both of them guaranteed versus getting one or the other. Okay, 9,000. I think we're kind of see where we're going with this. I have another example for the a 60. I did the same thing here with Nationwide. I did a 65 and 60-year-old couple, so I extrapolated out for 20 years. Again, it just keeps that. I could do this with every hybrid out there. Pac Life, Securian Life, One America. You can go on and on and on. The ULs, the IULs that have the chronic illness riders, those are. I didn't even put these in here because those are even worse. The premiums of those are even higher yet. The hybrids are going up in premium. The long-term care have already adjusted. So what you're seeing here is only going to get worse for these hybrids. So remember to my beginning slide, I'm not telling you that hybrids are wrong. Okay, in some situations, they're the absolute correct thing to be selling. Rollovers, refusal to buy long-term care for whatever reason. Maybe it is a dead life insurance money or etc. Maybe you do want the all cash benefit, or there's got to be the use it or lose it is just a terrible way or terrible reason. But I see advertisements all the time, social media, LinkedIn. Quit buying long-term care and wasting all that premium and lose it. You use it, and if you don't use it, you lose it. And it makes me a little crazy because I think people see that, and I think what's happening is I think even the financial planners, the agents out there, don't quite realize when I'm showing you this. So, in their mind, they're doing right by their clients. Their clients come to them and say, hey, look, I got a long-term care issue. My mom was just in a nursing home for, 7 years. We went through $450,000. We understand it. We need to start planning for this. So the advisor slaps down a hybrid. This way, if you buy traditional, you lose all your money. And it's all in one sale. They get life and long-term care, one app, one underwriting. So if I could tell someone, especially in that 10 pay with Nationwide, well, let's look at this one right here on the screen. For this 65 to 60-year-old couple, how would you like to pay $8,000 instead of $15,000? Over 20 years, how would you like to pay $140,000 less and have better benefits? I think that would get their interest. They might be willing to fill out 2 applications instead of 1. Because I don't know if it's just laziness or lack of awareness, or I can't for the life of me figure out why we're selling 5 hybrids for every 1 traditional long-term care. And I guess at this point, I go through these examples, it almost just, I don't know, it troubles me, I guess, that so many are being sold. So let me show one more here. And this is One America's, I want to show an unlimited, because that's the one thing. This is One America's, not the continuation of benefits. This is the 3-year and unlimited. So when people say, well, what if I want an unlimited benefit? Long-term care doesn't sell unlimited benefits anymore, and they don't. The unlimited policies, unlimited benefit disappeared by the way of the dinosaur here 10 years ago, 5 years ago. So I think I did bear with me here. I just want to bore you with all these. I've done so many of these over the years that, okay. Yep. Okay, so this was my argument with the continuation of benefits. Yep, okay. So in this example, the bottom, I'm just going to show you the bottom half here. Forget about the top one. This is without continuation of benefits. Okay. This lower one here, this is when I go to One America. This is for a 55 and a 50-year-old couple. Go one more up here. Yep, okay. So the bottom example here, this is if I want to have an unlimited policy with One America. So if I have the AOB and the continuation of benefits at 3%. Okay, I did a benefit here of 160. If you know One America, it's a 166 is a 3-year payout, the 33-month I think it is versus the 50-month. So you have the 166K death benefit, 5K a month, $166,000 life benefit with a 5K a month at 3% compound. So you get either 166,000 death benefit, or you get 166,000 long-term care benefit at the tune of 5,000 a month for 33 months, 3% compound. And I add the continuation of benefits down here. So in other words, without that, it's 7,000. Now it's 13,000, right? So now we have, and I can't, so what can I do about that as a traditional long-term care? I don't have unlimited. So if I were competing with that, I would jack my policy up to 500, $500,000. I would do the 10K benefit. And I put 1.5% inflation on here, which kind of compares, because I'm using 10K versus 5K. So I'm using a little lower inflation here. So that's going to grow about the same, because I'm starting out with 500K versus 166. So trying to keep as close as I can. And then I went ahead and added this second to die, because remember, with all One America, it's second to die. We don't have to worry about the second life policy. So that's $1,245 for this 55 and 50-year-old couple. The life part of this, to get the 166 guaranteed death benefit, is only $1,245. 1,000. The long-term care premium, as high as I can get the long-term care. This is a completely, fully maxed out long-term care policy. 8,711. Add to the 1,200, we got 9,000, as opposed to 13,000. So how does it shake out? 30 years from now, remember, this is a 55 and 50-year-old couple. So average claims happen at 82, 83, 81. I just read recently, it's dropping a little bit, 82. So 30 years from now puts them at 85 and 80. The benefit for the long-term care with the One America has grown to $12,139 per month. Probably won't get it done, but all right. And then their death benefit. Now this is backwards. I should say long-term care benefit over here. I apologize. These are switched. Is unlimited. They have an unlimited long-term care benefit. The death benefit is 166,000. That's an or deal, right? Ooh, no, no, no. Okay. So what I did then is, because I did a 500K and a 5K benefit, and I extrapolate this 30 years out of 3% inflation, they have a $15,000 a month benefit, well more than the 12,000 that One America was offering. And I have a pool of money, a long-term care benefit of 1.5 million. That's about 19 years of care, 18.7. Now I can tell you that 80% of claims don't go beyond 2 years. If you go up to 3 years, 90% of claims are done. 95% of claims are done in within 3.5 years. You start getting to 4 or 5 year claims, these are 1% of claims. If I start talking about an 18-year claim, it's less than half of 1 percentage point. It's a gut shot. So I feel pretty good about comparing 1.5 million to an unlimited benefit, especially when I'm saving them that much money, $4,000 a year for 30 years. It's 120,000 less in premium. And by the way, if they do get their benefit, I guess they're going to get the death benefit. So you get both benefits here. Okay, I think we see enough of those. I hope I've tried several ways to make people see what I just showed you, and I hope that how I've let these lined up kind of worked out for you, or you can kind of follow what I'm doing. One quick hitter for those use it or lose it clients, and boy, we overlook this. For a couple that might be, I don't know, let's just say you do with a $10,000 a month benefit. Mutual Omaha, I don't have the software open, but if you know anything about the Mutual Omaha plan, they have a return of premium rider that you can add. That's 3 times the maximum monthly benefit. So I feel like I have to show you this and I'll wrap up. Yeah, this is just too important. Bear with me, I apologize. Let me, so if I could give people, the use it or lose it fear. If I tell you, if you had this policy for 20 years, you're going to pay in about 100 grand. What if I could show you a way that I can guarantee you getting 60 grand of that back for a couple $100? All right? Let's see if this is open yet. Okay, so let me just do quickly here a 60. Okay, both 60. I'm going to ramp it up and do no inflation. So I'm going to do 10,000 and we'll do 250,000. No inflation. Take the inflation out of this thing. Okay. So 60 a couple, 1,827. So 4,500. Again, the average claims happen around 81, 82. So let's just say 20 years worth. Let's even, so 20 years worth at 4,500 is about 90,000. Let's just say they go a couple more years, about 100 grand, 90 grand is what they're going to pay on this thing. Watch this. If I come over here and do this, let's see, it's 4,582. Bracket challenge, must be basketball week. 3 times maximum. So in other words, I'm putting this at 10,000. So if I do this, what do they change the premium? From close to $4,600, 4,600 for 582. It moves it up to so it moves it up about $350 for each of them, both of them. Now what I have is each of them get 3 times this monthly maximum benefit. They get 30 grand back each. They die in their sleep and never need this. 30 grand each. That's 60 grand of the 90 grand I'm asking to spend, or maybe 100 grand. So they're getting 60% of their premiums back for nothing, for $100. So if these people are worried about getting their money back, I would argue, okay, instead of spending another 5,000 a year to guarantee getting your premiums back, how about if $100 a year and I'll get you 60% of your premiums back? You can keep the other 4,000 and you can do the math here. You come out way, way ahead. Why would you buy a hybrid? That just wouldn't be smart, right? There are tools and things available to us, folks, that you don't need to sell them hybrids because they use it or lose it. All right, so traditional or hybrid, right? And this is the second part here that we do another day. I have some ideas, quoting ideas. How do you get people over 2 applications? Because it is some more busy work. How do you get the advisors, agents to stop writing them and say, you can do a better job with that? So, you can look with, oh boy, a colleague just pointed out to me that NGL actually has an unlimited benefit as well. But with the again, with the Mutual Omaha example I showed you, $1.5 million pot of money is all but unlimited, right? I mean, that's 99.9% of your risk is wiped out. So you can compete with these hybrids, and I hope I'm not picking any one company here. Folks, you can do this against any hybrid out there. You can just knock the socks off it. If your client is really concerned about use it or lose it, I don't know, their golfing buddy, the lady at church, the financial planner, or that know-it-all brother-in-law has told them it's a dumb buy, I implore you to look into what I just showed you. Because unless they have that money sitting there, 180,000 laying around in an annuity or something, the hybrids just aren't a real good answer. You're not helping your client. I have another version of this that actually shows commission-wise. As an agent, not that we care about money, but you get paid a lot more when you sell a separate life and a separate long-term care. You're losing about 40% of your pay also. So everyone's losing when you do the hybrid. You know who's winning? One America, Securian, Nationwide. Clients losing, agents losing. Insurance companies love them, right? They're good money makers for the carrier. And they're going up. So everything I just showed you is going to get worse. So, okay. With that, I want to thank you guys for coming on board. I'm going to look for questions. I usually stir up a couple people with this. There's usually a couple financial planners that get upset with me. All right. Let me go through a couple of these. Apparently people like the Jack and Diane. When starting the monthly LTC benefit amount as it per person, for example, $9,030 a month, or male 9,000 for female. So what I'm doing is starting them at 5K, and I have a 3% compound in there. So that's why when I show you the next slide is showing you 20 years later. Yeah, and then someone also is pointing out here that the 1.5 million at 15,000 a month works out to about 8 years. That's 8 years each, I guess. So I was talking about a combined benefit of 16 years, but you're absolutely right, Jeff. It's about 8-year policy each. So together it's about 16, 17. And we also know that people don't go right to the nursing home, do not pass go. 80% of claims start at home. You start using some of that cash benefit. And so it's pretty rare you see someone go right to the nursing home and use all their benefit, but you're right. And to be fair, if you went immediately to the nursing home and spent it all, it'd be about an 8-year benefit each. Looks like I got a couple other ones. We'll add some more comments here. Other than that, it looks like it wasn't too bad today. Okay. So nothing too bad in the comments. So I appreciate that. I got a lot of compliments here, so I appreciate those. That's all I have for you guys today. I want to thank you guys for coming on board. I keep trying to change this. I've got to update a couple things in here as I noticed in there. So bear with me on that. It's an ever-changing market, as you know, but just do know that the hybrids I've been hearing, we've got a big asset company out in San Diego that's been telling us that they're going to be doing a lot more traditional long-term care because the hybrids they're working with have just went up like 30%. I won't say the names of the company, but he's gearing up to follow this exact concept. He's starting to teach some classes on it. So for those of you that are traditional long-term careists, I'm giving you some ammo here. I think that as an industry, I think we've shifted the wrong way. I think we're really not really helping our clients anymore. If they're truly trying to solve the long-term care need, which is what they started on this road to begin with, then help them with long-term care. If they want their money back, find a different solution. Don't give them a hybrid. Okay. With that, I want to thank you guys for coming on board. Hopefully we'll see you and talk to you at the next class, or good luck selling out there.
Check out our website, goldencareagent.com, or give us a call at 800-842-7799.